A troubling trend is brewing in the U.S. retail sector. Big names like Walmart, Dollar General, Home Depot, Kohl's, and other retailers are canceling billions of dollars in orders for the holiday season. The last time this happened was in 2022, right after interest rates started to rise. Now, a much deeper issue is forcing major corporations to cut back on imports, even as we approach the busiest shopping season of the year. This begs the question, what do these companies know about the direction of the U.S. economy that the rest of us don't? Let's investigate this together in today's video. It seems that things have been turned upside down in the retail industry over the past couple of years. Not long ago, companies were reporting record profits and rushing to stock up enough goods to meet consumer demand. But in 2024, retailers have been reporting sluggish sales and weaker than expected financial performances. Now, they're calling off a massive number of orders, leaving experts and economists alike worried about the reasons behind such extreme decisions. The holiday season is typically when consumer demand peaks. Under normal circumstances, this move wouldn't make any sense, but it's safe to say that current economic conditions are far from normal. At the moment, Americans are struggling with the highest costs of consumables and basic services in recent history. Pretty much everything has gone up in price over the past few years, but people's incomes have not risen accordingly. As a result, consumer spending is falling at a pace most economists wouldn't expect for this time of year. In fact, holiday retail sales this year are projected to have the slowest growth since 2018, according to a national retail forecast. The largest retail trade group in the U.S. said last week that it expects sales growth to decline by 3.5% compared to a year ago. The forecast considers economic indicators such as employment, wages, consumer confidence, disposable income, consumer credit, and more. Even though interest rates have come down, the damage they cause to people's purchasing power will have long-lasting effects. Consumers do have those interest rates and the lingering inflation on their minds, so we expect that consumers will continue to be more price-conscious and pragmatic in their spending decisions, National Retail Federation CEO and President Matt Shea said during a call with reporters. This is forcing many big companies to cancel orders and import fewer goods as they brace for another bleak shopping season. Reuters has reported that Walmart, the world's largest retailer, shipped 340,000 kilos of products described as holiday goods into the U.S. in the last 12 months, ending September 30th. That amount is less than half the 980,000 shipped in the same period last year. Dollar General and Home Depot have faced their fair share of challenges this year, with declining consumer demand dragging sales down, leading to store closings, as we've mentioned previous times on this channel. Meanwhile, Walmart is trying to lure consumers by offering discount and deals. The company's average price point for toys is $40.60 this season. That's 10% lower than last year, but even that might not be enough. Once again, retailers are afraid they will end up stuck with excess inventory they can't sell because consumers simply can't afford to make as many discretionary purchases as they could in the past. Kohl's executive said last week that shoppers, particularly those in lower income brackets, will feel more squeezed than a year ago. Christy Raymond, Kohl's CMO, noted that cumulative impact of high prices on food and other essentials is eating into people's savings. As companies aim to slim down expenses, they're also expected to hire fewer holiday workers this year compared to last year. Many retailers are indeed anticipating lower revenue and profit margins compared to previous years, primarily due to lingering inflation and higher consumer debt. Michael Barbera, Chief Behavioral Officer at ClickSuasion Labs, a marketing agency focused on consumer psychology, told the Post that these factors alone do not explain the full picture. What is really prompting retailers to cut orders by almost 50% right now? The answer is simple, but not easy to swallow. They're thinking about the long term. Although we want to believe that the inflation nightmare may soon be gone, its impact on the buying power of everyday Americans will linger for many years to come. A recent survey conducted by eShopping revealed that 56% of U.S. consumers are concerned about being able to pay for this holiday season. Wallets are still squeezed, making shoppers more intentional with their purchases.
The IMF, the International Monetary Fund, just recently issued a brand new warning about inflation and how it's not going to be going down as quickly or as easily as everybody thought, including the Fed. They said, oh, don't worry, inflation is transitory. Well, apparently it's here to stay for a long time, because this recent announcement from the IMF basically says that inflation may stay stickier than expected, which raises the prospect for higher for longer interest rates, which is something that we've talked about many times here on the channel. And a lot of people think that, hey, this is going to go away. Pretty soon in September, they're going to cut rates, which there is a possibility that they might. But even if they do, the rates are still going to be much higher than they were a couple of years ago. According to the IMF, they say that service prices and wage inflation are two main areas of concern when it comes to the path of slowing inflation. And another part of their warning here says that unless goods inflation declines further, rising service prices and wages might keep overall inflation higher than desired. And this is globally, not just in the US that they're talking about here. And why does this matter, guys? Why does it matter if they were wrong about inflation being transitory and it persists higher for longer and the interest rates persist higher for longer? Why is that a big deal? Well, it's a big deal because it poses a big risk to basically avoiding this recession, which isn't going to happen. This recession has already started, as far as I'm concerned, and will become official at some point in the next 12 months, most likely. And there's also a risk to the economy right now that a lot of people aren't thinking about, which is that even if growth slows in the economy, inflation can still persist. And that's because the slower growth can cause productivity to weaken. So companies won't have the benefit of higher productivity to offset wage gains and will have to keep raising prices to pay workers, especially when profit margins are already squeezed. So what we could be facing is the wage price spiral, where companies continue to charge more and more for their goods and services to keep paying their employees enough to keep up with inflation. And so everything gets more expensive for everyone, which can also lead to the economy slowing down even further because not everybody will be getting that pay raise to keep up with buying those goods and services. And therefore, different businesses start to slow down more, they start to lay more people off, and they close up their doors, just like we've seen so many do already so far in 2024. And another thing that could affect the global economy right now is the fact that the US debt is completely out of control. And what it's doing is it's causing us to rely more on short-term funding here in the US, which means that we have to go to market more often, and it increases our vulnerability here. More countries now are starting to impose tariffs and starting to be less trade friendly, and ultimately that doesn't help with inflation either. According to the IMF, they say that more than 3,000 trade restrictive measures were put into place in 2023, which is up from only 1,000 that were put in place in 2019. So, and every time this happens, usually another country will retaliate and put up their own trade restrictive measure in return. And all this restrictiveness just actually makes everything more expensive, as if that's what people need right now. Really, what we need is things to get cheaper. What we really need is deflation, but that is the government and the Fed's worst nightmare. Like, they don't want that. They don't want to see prices coming down. They just want to see inflation slow down, so where the price jumps are just not as extreme as they are today.